All right. Thank you, NR, for the quick welcome to everyone and the quick intro as well. So it's my pleasure to be here with you guys, right? I always enjoy having the opportunity to share what I know, what I've learned from the market with fellow traders like you guys. Okay. So today's topic here that I've prepared to share with you is a little bit more into technical analysis, specifically Elliott Wave. Now, some of you who are perhaps a little bit more experienced in your trading journey may come across the concept and the principles of Elliott Wave. Perhaps some of you are still pretty early in your journey of trading and you may heard of it, but maybe haven't really tested it out yet. No worries, right? Because if today, whether you have attempted to use Elliott Wave or you are very, very new to these principles, the intention and objective for today's sharing session is to give you the practical aspect of this principles called Elliott Wave and how we can actually use it to give us what we call a directional bias, right? In other words, we'll be able to identify from a chart in a fairly quick way whether we want to be focusing on a buy trade, a sell trade, or we just simply want to stay at the sidelines and wait for clarity. All right. So with that said, very quick one about myself. Of course, the focus is not me. But I thought, since I'm the one sharing with you, it's good to at least give you a background of who am I, especially for those of you who perhaps may not have heard of me before, right? So my name is Yong. Okay. I actually started trading back in 2012, and throughout my years, I've of course tried out many different methods. I didn't start off immediately with Elliott Wave, but right now I'm actively using this method and the principles to trade the market. Right. I turned full-time in 2015, and since then until today, I've been a full-time trader, investor, as well as I do a lot of sharings for fellow traders and investors, not only in Malaysia and Singapore, but across the globe. Okay, so I really enjoyed this, and I thought, one thing that's very important is to also share with you, of course, in terms of like social media, I'm pretty active on Facebook and Instagram. However, in today's context, there's a lot of fake accounts, or you could call it scam accounts out there. So those of you who are perhaps fairly new to me, do take note, okay? If you are active on social media, on Facebook and Instagram, if you'd like to follow me, just make sure the URL is my full name, Ang Yong, okay? So there's a lot of fakes, as I mentioned. They would use my name, my profile, and then they would like to reach out to you, whether through Telegram, DM you on Instagram or Facebook Messenger, and then they'll ask you to transfer money to them. Okay, just make sure you are very, very careful. Those accounts are not mine. Okay. Now, as we are talking about trading, I thought it's also important to share with you very quickly, the practical aspects and the results of trading. Not to really do any form of comparison, but I think it's really to give you the confidence that whatever we're going to cover today is something that is practical, is something that you can actually apply and see results in trading. Okay, so very quick one here. This is the 2022 portfolio, which is my last year's trading results. I have 3 accounts over here. You can see from January to December, of course, there are some months they're pretty good. There are some months the results are slightly slower. Right. And this year over here, all the way until the end of May, we're concluding June, in a couple of days. But this is actually all the way until May. You can see this is this year's result, right? Same thing over here. We have pretty good months, and then some months are maybe fairly slower. Right. So what I want you to do is, of course, not everyone would be aligned and not everyone would love about Elliott Wave, okay? But I just hope that today's sharing will give you a different perspective. And of course, right, if after today's session, you kind of fell in love with Elliott Wave principles, by all means, I do hope that that will also give you an advantage in whatever strategies or trading styles that you're using, right? To help you to maybe improve, okay, on your results. So what we're going to cover in today's session over here, the first thing, of course, we're going to talk about the impulse and correction principle. That to me is what I call the building blocks of Elliott Wave. That's the most important foundation that you need to build up if today you want to really understand and utilize Elliott Wave in your trading and analysis. Okay, so we'll talk about what is impulse and correction. Okay, and then after that, we'll talk about how to use the impulse and correction principles to start analyzing the charts, right? We'll talk about patterns. We'll talk about giving some kind of like estimation and expectation of timing. Okay, and then after that, with all this that we've covered, you'll be able to establish what we call a directional bias. Now, in trading, there's only two things you need to always get it. One is, of course, the direction that you want to focus on trading. That's what we call directional bias. The other aspect is all about timing, right? Timing is all about execution. Okay, so if you have today established a directional bias, for example, you would like to buy, right? For whatever analysis that we have done, the analysis gives you a higher probability direction to focus on buy. That's your directional bias. Now, after you have established that, you need to then establish your timing. Okay, so now that you are interested in buying, when is the best time to get involved in it? When is the best time to get out? That's what we call execution. Okay, so today's focus very much will give you the first component, which is to establish the directional bias, right? And that to me is fairly important. Okay, now execution, there are many different ways that you may execute a trade, right? That's what we call a trading strategy or trading plan. Now, some of you may use certain indicators, some of you may use Fibonacci, some of you may use price action. Okay, whatever it is, as long as it fits your style, I think that's the important aspect, right? But the directional bias is where, with Elliott Wave principles, it can really help you a lot. Now, over here, I just want to very quickly show you that this method doesn't only benefit myself, but I've been sharing this for some time, right? If I recall, somewhere since 2016, I've been sharing the principles of Elliott Wave. So that's about like 6 to 7 years. These are just some of the feedbacks that I got from some of the traders who actually use it, right? So this is from Kevin. Okay, so very quickly you can see he actually wrote in, it's a great intro of how to use Elliott Wave to identify trades based on pattern and impulse and correction structure, which is practically what we're going to talk about today. Over here, Ted, right, enjoying some profits, right, from based on the analysis on Elliott Wave, and this is another one, okay, that he felt more confident and get a clearer direction before going into the trade. You're going to take away from today's session if you pay attention to it. Okay, so with that said, let's jump into the content on impulse versus correction. Okay, so as I mentioned, this is like the most important aspect in Elliott Wave if you really want to pick it up. Right, so what is impulse, right? What are impulses? Impulses are basically movement that are very fast, that have strong momentum in the market. So in terms of direction of an impulse, it can go up or down, right? We're not talking about direction now yet, but the idea is we want to understand this particular move in price. Is it fast or slow? Okay, if there's a lot of momentum, the price changes very fast. That's what we call an impulse. Okay, so as I mentioned, it can be in either direction. It can be in either time frame as well, right? So if you are more of an intraday trader, perhaps you're looking at 15-minute, you're looking at 30-minute, you can identify impulses. If today you are more of a swing trader, you're looking at H1, H4, you can look at impulses as well on those time frames, right? So it's time frame independent. It doesn't matter what time frame you're looking at. It doesn't matter what instruments you are looking at as well, because we're essentially describing how price move. If it's going fast, it's an impulse. All right. So if today I'm going to show you some examples of it based on different assets, right? So this asset here is Netflix, right? Netflix is essentially a US stock market. This is a daily chart. It can be applied as well, right? You can identify impulses on US equities, you can apply it on FX, you can apply it on indices, you can apply it on commodities like gold, same thing, right? So if you take a look at this one over here, okay, very quickly to annotate it, right? So you can see this drop in price is very fast, right? Similar here, this drop in price is very fast. Now, when we are talking about fast, it's always in comparison. Okay, when you say something is moving very fast, you need to compare it to what's slow, right? Because if you describe it as fast, there's something that's slow. So how do we look at it? Of course, you can look at certain moves in the market. Okay, so things that in the past, right? You can see here, these are all very slow. It takes time to develop. And when it starts to drop here, it's fast. Okay, so that's the comparison that I would like you to see. Okay, obviously, as this is going up, this is fast move too. Okay, so again, doesn't matter like which direction it is. The important aspect right now is to identify and be familiar with what we call impulses. Now over here, these are impulses as well. Okay, so this went up pretty fast, this came down pretty fast, and of course, internally, it comes in various sizes. This came down fast, this went up fast. So all this here are basically impulse move. Okay, so you can see, right, some of the characteristics of it is basically huge candle. The color of the candle, which means if you have bullish candle, you can see, there's a couple of bullish candle together. Okay, same thing for bearish candle. There's a couple of huge bearish candles together. That's impulsive in nature. Okay, so more example, you can see this drop is fast, this drop is fast, this push up is fast, this drop is fast, right? So again, this is on the gold chart. The previous one is on the currency chart, and then the first one is basically on Netflix, right? Which is stocks, right? So whether is it stock market, FX market, commodities market, same thing, right? That's the principle behind it. So that's the first type of movement in the market, right? Now, if today the market is not moving fast, then the next thing that it can develop is a slow move, okay? And we give it a name, it's called corrections. So if the market is not basically moving impulsively, then naturally it's going to be a corrective move, right? Because in the market, there's only two ways the price can move, fast or slow. Fast is impulse, slow is correction. Okay, so corrective moves are basically slower in nature. It takes a longer time to develop. Okay, and in terms of like price movement, it's smaller. Okay, it's not moving as fast as impulsive. So again, same thing here. It doesn't matter the direction. A correction can be sloping up gently. It can be coming down slowly. It can be going sideways. Again, we are not so particular with the direction. We are more in particular with how price is doing, right? How price is developing. So give you some examples again, right? So you can see here, those that have gray out, they're basically slow move in comparison to what? In comparison to this move is fast, this move is fast, this move is fast, this move is fast, right? So you realize some characteristics of price movement in a correction is there is a lot of ups and downs, okay? And then of course you realize that the candles tends to overlap a lot, okay? So you look at this up move here, you get couple of white candles string together, maybe only one red here, and then this down move here, there's huge red candles one after another. Right? So corrections, you look at the nature of it. Okay, we have like white, red, white, red, white, red, and then it's basically going sideways, right? So those are corrective moves, right? So I think visually, you just need a little bit of practice. Okay, you'll be able to identify and separate impulses versus correction. So this one here, I put it together. You can see impulse up move very fast, starts to slow down. Okay, fast move up, starts to slow down, right? So always ask yourself this question. How is price developing? If it's slow, correction. If it's fast, impulsive, right? So that's the idea behind it. More example, drop is fast, correction, fast. Of course, this here, a lot of impulses within it. This is fast, this is slow. Okay, so any market, any time frame, you open up a chart, you'll be able to identify either an impulse or correction. Now, there will be at times that things are not clear. Okay, even for me, sometimes we look at the chart, you may second guess, right? Is this fast? Is this slow? When things are not clear, you skip it. Now, example of it is like this, right? So this is a very clear sense it's coming down, but is it coming down fast or is it coming down slow? Now, some of you may say that it's impulsive in nature. It seems to be coming down quite strongly. But some of you may argue that it's not the case, right? Especially look at this here. It's red, white, red, white. There's a lot of overlap. It seems slow. Now, especially this part here, it seems slow. So when things are not clear, stay out. You always identify and only work on the charts that are clearest to you. Okay, so that's something you need to know. Okay. The market is not perfect, okay? And we don't need perfection to be trading the market, but what we want is clarity. You want things to move in a very clear environment. You are clear, you are confident in it. Those are the charts that you want to pay attention to, okay? So typical nature of correction, right? It tends to be slow moving. It tends to be wavy in nature, as I mentioned, right? If you look at candles, they basically have red, white, or basically bullish, bearish, one after another. So kind of overlap a lot, and that gives you that wavy nature. Okay. So again, if you see some tips, right? If you see a lot of impulses one after another, right? It drops very fast, it goes back up very fast, it drops very fast, it goes back up very fast. Whatever time frame you're looking at, if you identify a nature of this, my suggestion is you can zoom out, right? Go to a higher time frame, and you start to realize that, oh, whatever you're looking at it just now is basically a correction. Now, I'll give you an example, right? So if you take a look at this chart here, is very, very choppy and a lot of fast move up and down as it's developing, right? Okay. So this entire piece here is on the hourly chart. Okay. So if you identify something in the market that looks like this, you can actually go up to a higher time frame, and you realize that whatever we identified just now is essentially a huge corrective move. Okay. So again, when you feel that, well, it's very confusing, there's a lot of impulses one after another, the tip is to go to a higher time frame. You would see a correction. Okay. Now, before you jump to the next segment, I just want to jump over to a live chart and very, very quickly, really show you on the live environment, okay, what are impulses and what are corrections, okay? I'm going to work with some very, very simple examples and instruments, right? I'm just going to scroll through maybe some of the charts over here on maybe a 4-hour chart, right? So if you take a look at this here, right? Again, we won't work through too many examples. I just want to show you in the recent environment, how do we separate things of impulse and correction? Now, this move down, okay, I think it should be very, very clear. I mean, like, there are about 80 plus of you over here. I would say, a good 90% of you, or even 100%, everyone would agree that this move is impulsive in nature, right? The reason is because we can see huge red candles and it's coming down very fast, okay? And then the other one in comparison, right? If you take a look at this development here, again, I would say, almost 90% or even all of you would agree that this is corrective in nature, right? Why? Because the candles are small, it's basically coming down, but it's taking a long time to develop as compared to this move down, all right? So this is on FX side, right? If you take a look like commodities, can you look at it? The answer is yes, right? So again, if you take a look at here, a lot of up and down is basically impulses one after another. Zoom out, okay? And then what you realize is this entire piece is basically very slow. Now, direction-wise, it's coming down, no doubt about it, okay? But how is it coming down? It's coming down very, very slow, okay? So that's correction. What's impulse? This is impulse. You can see, right? The movement, the fast move up, slow move down, right? So that's a very, very direct contrast, okay? Now, can you apply to cryptocurrencies? The answer is yes, right? So look at this, fast move, slow move. Recent one, fast move. I think this is very, very clear, right? So some charts are clearer, some charts are not that clear, right? So again, if you are basically trading the entire market universe, focus on things that are very, very clear, okay? And then of course, you need to be also working on your individual particular time frame, right? These are just examples that I'm working on the daily scale and forward scale, right? So that's a very quick one that I just want to very quickly jump into, like, current market environment to just show you that the principle of impulse and correction applies, okay? Now, once you are able to identify impulse and correction, then the next stage is where things get very interesting. You'll be able to start to build up what we call a directional sense, okay, a directional bias. And this is where I kind of categorize the patterns into 3 categories, okay? And if you are familiar with maybe, puzzles, or you are familiar with maybe, Lego piece, right? Just think of it as impulse and corrections. They are your pieces of puzzle, okay, or your pieces of Lego piece. And what we do next is basically play around with it, right? Mix and match, okay? And there's kind of a limited number of possibility, simply because impulses, we only get 2 directions, okay? Because the market is either going to go up fast or come down fast, okay? So impulses, we only got 2 pieces, up and down. Corrections, we do have 3, because the market can be slowly going up, the market can be going sideways, the market can be slowly coming down, Okay. Now, if you're very particular with that, we total have like 5 Ps, right? So you basically play around with mix and match. Okay, and you can't get kind of like certain combinations, and that's it. Okay. So over here, I'll talk a little bit about it. Okay, so we'll start off with the first combination. So the combination for the first one here is we take an impulse move and then we combine it, okay, with a corrective move that is sloping in the opposite direction of the impulse, right? So the upside is fast, the downside is slow. The downside is fast, the upside is slow. Okay, so this is basically just mirroring opposite. Okay, so this is the first category. Okay, so we basically take an impulse, combine it with an opposite correction. Okay, now the second piece is where we get 2 pieces of impulse one after another, right? We call this a V-shaped formation, right? It basically looks like a V. Okay, and then the third combination, kind of similar to the first but slightly different. We have an impulse to start off with, but the next piece here is a correction in the same direction as your impulse move. Okay, so it goes up very fast and then it slows down. Okay, same thing here, it goes down very fast and then it slows down. Now, you may ask, right, what about an impulse followed by a sideways correction? Okay, which one would I put it in? For this kind of category, I'll put it under first one. Okay, so first one basically means it can be either sloping down or it can just basically chop sideways. Okay, so that's the first category. Now, if you think about how the market can eventually move, it's either going to be 1, 2, or 3, right? And I would say 90% of the time when you look at a chart, it's either going to be either 1, 2, or 3. Okay, now there'll be like that 10 to 15% of probability where things are just not clear. Okay, but other than that, majority of the time when you scan through a chart, when you open up a chart, whatever time frame it is, you can either see 1, 2, or 3, either of this. Okay, now very quickly, right? I'll just jump back in to the chart to just very quickly show you some examples, right? Now take a look at, this piece of combination. Okay, that's essentially our first combination, right? Impulse correction. Okay, take a look at this piece here, fast, and then continue to go up, but in a slower manner. Okay, that's your third piece. Okay, that's your first example. That's your third example. This is what we call a V shape, right? Inside here, there's a 2. All right. So from this price point all the way until here, we basically can see 3 combinations within it. Okay, so that's basically how it looks like. Okay, now if I bring up maybe another example, currency market. Okay, maybe playing with it on a different time frame. Okay, let's go to the lower time frame. Again, you can see here. Okay, just work on the recent one. I mean, this is pretty sharp. Okay, so that's a fast move up. But before that, can you see this one here? Candles are slower, it's coming down slow. This is fast, this is slow. That's your first category. Okay, this is a V shape here, so that's your second category. This one here, fast, slow, that's your first category. Okay, so most of the time you'll be able to see that. All right, so I wouldn't want to spend too much time on that, but I just illustrate very quickly, then we move on. Okay, so why is this important? Okay, the reason is because once you understand that these are the few possibilities in which the price tends to develop, we can then use this to study the pattern. Okay, whenever something like this happens, what's next? In history, if there's a certain probability of things happening after certain patterns, then we can actually rely on it to trade it in the future. Okay, so let's talk about first pattern over here first, right? The combination of an impulse then correction. So whenever we see this combination, we do have a high probability direction that we can trade off. Okay, and the direction that we're going to focus on trading is basically the direction of the impulse. Okay, so what this means is that if we see a fast move up followed by a slow move down, the chance of this going up is almost about 70% of the time. Okay, so it's a high probability direction. If we see the market came down very fast and then it forms a correction that looks like that, there's a 70% chance, okay, it will actually continue to drop. Okay, so that's what this means. Okay, so when you see this combination, the next direction that you want to forecast It's basically following the direction of the impulse. Okay. So this one is where we talk about directional bias. Okay. So directional bias doesn't mean you immediately go and buy, right? So we talk about this. This means that you want to focus on that direction. How to get involved in the buy, when to buy, which price to buy, where to cut your stop, where to put your target. Those is what we call execution. Those are timing element, right? And that is another whole big topic because there's a lot of strategies that you can use to execute a trade. Right. But first thing you need to, of course, establish a direction first, right? You need to know whether you want to be buying or selling. Then only you determine where to buy, when to buy. Okay. So give you some example, right, of what I meant by studying about historical patterns. Now, this year has already happened, right? But I just want you to see the historical pattern of impulse, correction. What happened next? The market went up. Impulse, correction. What happened next? The market went up. Okay, so this basically gives us a certain sense of pattern. In the future, if we see an impulse, we see a correction. Now, it may not be 100% going up, but we know there's a high chance it will go up, right? So as I mentioned, 70% of the chance it will go up. We want to focus on buy. Okay, same thing here. If you flip it, every time it comes down, correction comes down. Fast move down, correction, continue down. Fast move down, correction, continue down, right? So again, this is a pattern that tends to repeat itself over and over again. So how can we capitalize on this? Very straightforward. In the future, when you open up a chart, you see a fast move, you see a correction. Where do you think there's a higher chance of the market going, right? Of course, the market can go up, it can chop around, it can continue to go down, right? So if you give it a probability, I would say 70% it will go up, okay? Now, maybe 20% it will come down, and then 10% it will continue to just do its correction, right? So the idea is we want to focus on the high probability, which is up, right? So our directional bias will be bullish, will be more interested in the buy trade. How to get involved in it, that's where your strategy kicks in. Okay, so that's where the pattern comes in. That's where the study and the understanding of impulse correction put together comes in. Okay, now if you flip it, it's the same, right? Impulse down, correction, you will expect and you will want to focus on downside. Okay, so quite straightforward, right? I mean, once you understand this from the foundation, building it up, okay, from the basic understanding of impulse correction, you start to build this up. It's not complex, right? It's quite straightforward. Okay, now that's the first category. The second category is the impulse, which is what I call a V shape. Okay, so whenever we see this, we stay out of it. Okay, simply because there is no advantage in determining the direction, right? When something is like 50-50, you don't want to touch, right? Because 50-50 means the probability is not in your favor, right? So whenever we see something like this, we just wait, give time for the market to keep developing the next piece first, then we come back in the future. Okay, so examples of it. Okay, this is V, this is also V, right? So in this entire piece of environment, we don't touch it. But you realize as you wait, you know, eventually what the market does, it does this pattern. Okay, and this is a pattern that we can recognize. Impulse correction, we know the higher chance is down, right? And that's what happens. But in this kind of environment, you don't touch it. Okay, so that's very, very clear, very straightforward. V, stay up. Now, there'll be a couple of V's in the market, right? Like this one V, this one come down quite fast. Basically, this entire piece here, don't touch it. V shape, don't touch it, right? V shape, don't touch it. Okay, very, very easy. Now I'm going to give you maybe some examples as well, right? So if you see just an impulse leg like that, again, don't trade. Okay, so very quickly, right? I just want to show you some examples when we talk about V shapes, so you get an idea what it looks like. Okay, now this is a daily chart. You can see this is basically what I call a V. Okay, so what you do here, nothing, absolutely nothing. Don't buy, don't sell, just leave it. Okay, so that's what we call a V-shaped formation. Can follow, yeah? Now different time frame, you might see things slightly differently. Okay, I want to find an impulse correction example for you that may have been completing soon. Okay, let me think about it. Okay, this one. Okay, it may not be so clear to every one of you because sometimes it takes a little bit more practice. Okay, But this one here may be developing a correction that is sloping to the upside, and then we have this fast move down. Okay, now it's not probably going to be like the nicest looking one, but I think on top of my head, this is probably one that you can look at. Haven't finished, the move has yet to be done, but it's something that is building an impulse correction, right? So I'd like to work on things that are more forward looking, okay, because things that have already happened, I think that's just basically to study the probability of it, but it may not give you opportunity, right? Because things has already happened. Okay, so I hope that gives you some idea, okay, about V shapes. I think the clearest of all is definitely Aussie dollar. That's what I have immediately when I think of V shapes to show you. And then in terms of corrections, nothing just jumps out on my head right now. Okay, so that's the two pattern. Okay, the first is impulse correction. The next is V shape. Okay, whenever you see V shape, don't touch. Okay, then we have the third. Okay, the third one here is essentially impulse then crawl. Okay, so if you still remember what impulse then crawl is basically a fast move up and then it slows down. We call this a crawl move, or it comes down very fast and then it slows down. We also call this a crawl move. Okay, so whenever you see this combination is telling you a potential reversal is coming. Now, is it 100%? Again, no, nothing's 100% in the market. But when you see a pattern like that, okay, again, in probability, that is a 70% chance it will come down. There's maybe a 20% chance it will continue to go up. And then maybe there's a 10% chance it will just chop sideways, right? So which one you focus? You focus on the higher one. Okay, so that's the whole idea about directional bias, right? So you follow the opposite, which means that this pattern is a rejection pattern. Okay, so in this case, we look for counter trend opportunity. Now, if you are a counter trend trader, this becomes a trading opportunity for you. If you are a trend following trader, okay, which means you just want to trade in the direction of the trend, then at least this pattern will serve you a purpose of not getting in, anymore, right? You may want to be very cautious in buying it up if you see an upside crawl. Vice versa, if the market comes down, it starts to crawl, you may not want to be actively selling it, right? If you are more of a trend following, just be careful. But if you are a counter trend trader, then that's where your opportunity comes in. Okay, let me show you some examples here. So you can see this went up initially very fast, and then after that, it starts to slow. So what happened on this example? It went down. Okay, so it came down fast, and then it does a correction again, going back to pattern one, it drops. Okay, this is a V, pattern two, right? So in this case here, you have like pattern three, pattern one, pattern two, from here to here. Okay, so that's again tendency of market happening, right? Give you more example, right? This came down, and then it starts to slow down, and then what happened next? It reverses, right? So again, in the future, when you see a pattern like that, fast move up, crawling up, you expect the downside. Okay, so you focus on sell opportunity if you're a counter trend. If you're trend following, at least this tells you don't buy it yet, right? Don't be too aggressive buying. Okay, same thing here, it came down, it starts to chop slower. Be careful in selling. If you're counter trend, look for the buy. Okay, now give you some examples of a crawl potentially happening, right? So I think over here, one that I'm looking out quite closely will be the pound yen. Okay, so if you take a look at this here, this was very fast. Okay, and then this piece here, you see it starts to slow down. Okay, so this is essentially an impulse and then a crawl. There's a higher chance probability that it will drop. Is it 100%? No, it's 70% chance that it will drop. So naturally, do you want to be buying here? Probably not. You want to be focused on the sell if you're counter trend. If you're trend following, maybe you be cautious. Don't buy it there. Wait for a decent pullback before you get involved in the buy, maybe. Okay. Another one that you can potentially look into for a crawl. Let me just look at this, right? It's another time frame, right? So you can obviously always play with different time frames, right? It's potentially developing in terms of pound dollar. Okay, so this is a fast drop. Okay, this may be starting to crawl a little bit, right? As it's coming down, it seems to be slow. So again, what do? Don't sell it there. Okay, you might be looking at a potential reversal, even if it's a short term back to the upside, right? The idea is giving you a sense of direction. Okay. Aussie yen. Okay, now Aussie yen on the 4-hour chart, I just recall this, is potentially developing the first category, which is impulse correction. Okay. So on the 4-hour chart, right, I think this is quite clear, right? Fast move. This is definitely slow. Okay. So if you are quite kind of savvy with some basic technical analysis, you can even play around with tools such as channeling. Okay. And then you can see this is basically very, very slow. This is fast. So what is the direction that you may want to focus is upside. Okay. So again, once you identify and you're familiar with all these principles, right? Building what we call a directional bias is not complex. Okay. It all boils back down to impulse correction, the various combinations of how they play around with it, and then understanding the probability of where is it likely going to head towards, right? And that's the whole idea of this tree combination. Yeah, so I hope so far you guys are following through. You guys are taking some notes. Okay, so very quick visualize summary of what are the three core patterns. Impulse correction, that's the first. V shape, that's the second. Third is the crawl. Okay, good. Now, with all this said, okay, let me walk you through and show you some of the analysis that I've done. Sharing with you also some recent opportunities that I'm personally focusing on. Okay, and then after that, we might have like another 15 minutes of Q&A. Okay, so if you have any questions, I'll be able to answer that. Or if you have, let's say, any particular instruments you'd just like me to look into, okay, we'll be able to take that 15 minutes to do this. Okay, so very quickly, some charts over here, you would see a little bit more of a labels, a little bit more information. Obviously, with today's time limit, okay, of a webinar, we won't be able to cover, the entire universe of Elliott Wave, right? But what I've picked up over here for you guys today is the starting point, right? The most practical aspect and the most important aspect of Elliott Wave to start with. Okay, so if you look at some of the things here, you may not fully understand, like, what is that 1, 2, 3, 4, what's the ABC, ignore them. Okay, because the underlying principle is all about impulse and correction. Okay, now over here, right, that I will also talk a little bit about this thing called visualization, or I tend to use this word a little bit more, forecasting. Okay, now the idea is, as an Elliott Wave trader, okay, you need to develop your sense of forecasting or visualization. Now, what it means is that you need to imagine things a little bit before it happens. Okay, now I'll talk about the example on euro dollar. Okay, so let me just remove all these things away. Okay, now I want you to visualize, right? Imagine. Okay, I mean, first part first, okay? Don't imagine first, but look at it first, okay? This is definitely a fast move. Okay, I think everyone will agree, okay? This upside is relatively fast. It's an impulse. Okay, now the next step is you need to probably imagine a bit, right? Imagine if this starts to come down and develop something like this. Now, it hasn't done it yet, but let's say it does like that. Okay, so just imagine you give it a couple of days, next week you come back and look at euro dollar, and then you observe, oh, it went up, it came back down. It's basically doing this slow. Okay, so when that happens, you would then see a very nice combination of what? Impulse correction, and then you'll be expecting upside. Okay, so that whole process is basically what we call forecasting. Okay, so over here, as we are looking at trade opportunities, you need to do a little bit of forecasting, right? Because things have yet to happen, but we are planning in the event that happen. Okay, so look at euro dollar, for example. Okay, so you can see my directional bias for this week is bearish. Okay, because of course now we have already seen this move, but at the start of the week, okay, we're basically expecting price to come back down a little bit more. Okay, towards this area here, you look at it as some of the fits level. Okay. Again, today we may not, have the luxurious time to go into the details of it, but basically what this is just a measurement of this move mapping here, right? So it's basically equal length that we're measuring, and therefore 100%. Okay, 1:1. That's what it means. Okay, so what we are looking at is potentially this will come down a little bit more. Once it tags this area, we'll be expecting this to bounce. Okay, especially if this comes down slow to complete this as a correction, impulse correction outside. Okay, so that's what we call forecasting. Okay, so in other words, this week we are looking at this to come down a little bit more. Then moving forward, once price tags this area, we'll be looking at opportunity to go up. Okay, so we can actually plan ahead, right? Before the market happens, if this is going to develop, I'm going to do this. If that's going to develop, I'm going to do that, right? And that's actually the strength of Elliott Wave. Okay, so euro dollar, that's what we're looking at. Another one here that you might want to pay attention to is the dollar Canadian. Okay, now dollar Canadian is actually right now what you're observing is we do have a crawl, which is basically, you can see, right, third pattern. We did get a bounce yesterday, right, which is great, right? Again, nothing surprising because why? Probability wise, there's a 70% chance of bouncing. Okay, and then right now what we have developing, not done yet, but developing is impulse. If this comes down slow, what do you have? You basically have your first category, you look for upside. Okay, so again, based on just the principles that we covered today, you can build up a very good sense of direction with high probability. Okay, of course, you need to add in elements like, fibs, that's the execution, basically where to get in, when to get in, what's the setup to look out for. That's the strategy, right? And everyone would have slightly different techniques. Okay, so dollar CAD is definitely one to keep an eye on. Okay, potentially looking at upside. Okay, the other one I think I just mentioned as well is the pound yen. Okay, so pound yen here, you can see basically this is the crawl, this is the impulse push, so we're looking at bearish bias. Okay, now if you're again technical analysis savvy, okay, you can play around with multiple time frames, right? So on the higher time frame, on a H4, we have a crawl, which tells us direction is downside. You can play around with multiple time frames. You can go to the H1, and then H1 you see, 1 hour chart, very nice. We have a fast move, a correction. So what is this pattern? This is the first category. On the big time frame, we have a pattern 3 crawl. And then on a small time frame, we have a pattern 1, which again, both tell us there's a good chance of downside. Okay, so this is what we call multi-time frame alignment. It will help to stack up the probability. All right. So with that said, I think pound yen is definitely an opportunity to keep an eye on for going forward, right? This week and next week. Okay. Now, if gold is very, very kind of like attractive to many traders, right? But at times you don't need to always be trading the market. Okay. Now let me show you my view on gold. It's neutral, right? What does neutral directional bias means? Means that things are not the best looking right now. Be patient. Okay. Now, why would you want to be patient? Because the market is always developing, right? We always say this. The market can only go to the right-hand side, right? Because it's always developing. Now, when things are not clear, you stay out of it. Eventually, at some point in time, it's going to develop into something that's clear to you. Okay. Now, of course, we do have a little bit of a crawl here, right? Now, before today, we don't have that clarity yet. But I think, with this little spike here, with this little low, I think if this continues to go up a little bit, we can say that, okay, we have a crawl. Okay, so when we have a crawl, what is the directional bias? It's naturally upside. So you can see, while I'm neutral, I'm already establishing a little bit of a directional bias, right? So basically, I'm not rushing into this potential trade, but I want to wait for some more confirmation. Okay, I want to wait for price to really show me an impulse first, followed by a pullback. And that's giving me my first pattern. Then I'll look for upside, right? So we have then this coming down as a third pattern. And then I want to wait for a first pattern. Okay. So again, going back to the basics that we talked about today, ignoring all these numbers, you are still able to look at the market. Okay. So hopefully so far you guys are following through. Okay. Yeah, so I think we do have like about 15 minutes, right? I'll take some questions. But before that, I'll just very quickly show you a slide. Okay. Now, because what I've done is today we talk a lot about the directional bias, right? Giving you the skills, the ability to identify based on the chart, whether to buy, whether to be focusing on sell, whether to be staying neutral. Okay. If let's say you don't have any strategy of yours and you like to study a little bit, in terms of like what are some of the trading setups that I use, I've actually put together a handbook. Okay, I put together a handbook where I cover the 4 setups that I take. Okay, now I don't call them strategies specifically, I call them setups. What are setups? Are basically a certain sets of conditions and criteria before I get into a trade, right? So that's the execution phase, right? So that's why we call it the trade execution handbook. Now, this one here, if you're interested, you can scan this QR code. It's not free, but it's $1. Okay, which essentially should be considered free, right? I mean, $1 is so affordable that I think everyone should be able to be affording it. Okay, I don't like to give stuffs away for free. The reason is simply because today you download this for free, you probably just put it aside and then you don't study it, right? At least you pay $1 to it, you probably study it. Okay, that's the whole idea behind it. Hey, now these are 4 specific techniques that I personally use to get involved in it, right? Let me show you maybe. Okay, let me just very, very quickly show you one examples of, one of this, okay? Now, we talked about the pound yen just now, right? So I just want to illustrate to you, okay, one technique that I personally use and cover in the handbook, okay? We've done all the directional bias, right? And we already established that we're interested in the sell, okay? So this is where we can use the breakout technique, okay? So one example of this is basically impulse, correction, direction is downside. The breakout technique basically means that we're looking at the low to get involved in the sell, okay, and then the high of the correction becomes our invalidation, okay, which means your potential stop loss, okay, and that's the idea of how you're going to look at it, okay. So your target, okay, we basically just use the recent low or significant high, and then that's how we execute, right? This technique that I'm showing you now is what we call the 3-wave breakout setup. Okay. So again, these are all covered in details, like what are the stats, what are the conditions, etc. Right? Okay. So just want to very quickly cover on that for those of you who are interested to maybe study a little bit on technique and the strategy. Okay. So with that said, let's take a look at some of the questions that you guys may have. Okay, you can scan the QR code here, right? If not, then you can go over to the website link directly as well. It's basically called the tradingdose.com/handbook. Okay, so that's the link if you're interested in. Let me just copy and paste it. Okay, here. Good. Okay, so let's see some questions that you guys have. Yeah. Hey, if you have any questions, put it in, okay, so that I can answer it. All right, so I see a question here. Azizan asks, correction and sideways, is it the same? I think that can explain a little bit, right? If you're not clear, basically correction and sideways, I categorize it as the same. Okay. Good. Okay, Richard asks, correction need to have a minimum of 3 waves. Yes, in terms of details, right? So let me just go down to the details of that as well. Now, part of Elliott Wave principle is that we tend to expect the market to develop in 3, right? So if you take a look at this, right, from this low here, it starts to pull back. This is 1, this is 2, this is 3, right? So that is what we call a 3-wave move. Now, it need not always be 3, but again, we need to have certain sets of conditions and criteria to guide us in our decision-making process, right? So for me, I always like to wait for at least a very clear 3-wave move. Then I would say, okay, this correction is likely going to be done. We can look for the trade, right? So pound yen here is basically the example where you get a fast push down. Internally here, we get a 1, 2, 3. So more or less, this can be ready to drop. Okay, and that's the reason why I'm looking at that potential sell as a breakout. Okay, sometimes it can develop more than 3. Okay, so what it means is that it can do a 1, 2, 3. This is a small piece. Then it can do another, 4, 1, 2, 3. Right? So it can develop into a bigger piece, and then internally you would have 1, 2, 3, 4, 5, 6, 7. However, okay, you can also see it as a 1, 2, 3 from a bigger time frame perspective. Right? So that's really the beauty of Elliott Wave, right? But of course, if you're fairly new to all this, and this is the first time you heard of it, you may be a little bit overwhelmed. It's common, it's normal, right? Because there's just so many information. But that's where today, again, I don't want to go into so many complex stuff, but I just want to give you the most important aspect where you can really apply it immediately. Okay, so that's where focus back on impulse and correction to get started. Okay, good. I think there's another question over here asking, is it the same as flat pattern? Now, if you are referring to, the impulse correction that we talk about, and is this a flat pattern? The answer is yes. Okay. So if you're familiar with some of the chart patterns, right, like flat pattern, double top, double bottom, wedges, diagonals, again, they have some similarity with Elliott Wave pattern itself, right? So this is basically called a flag. From Elliott Wave perspective, it's called a zigzag. Okay. I basically just call it correction, right? So that everyone can understand this is basically built up from 2 pieces, right? Fast and slow. Okay. If you see it as a diagonal, right, or we call it a crawl, essentially you can call it a diagonal, you can call it a wedge, you can call it a crawl. It's the same looking pattern. Okay. This has a probability of a reversal. Okay. Okay, so crawl is a sign of reversal, yes, right? Over here, Amrizan asks how to point the fib, right? How to draw fibs from point to point. Very good question. Now, if I were to again use back just example in pound yen, okay, for me, okay, what I like to do fibs is I always take the highest price point from the impulse to the lowest price point, right? So some traders I know they just look at the candle body. Basically use the highs, high and low. Okay. So if I want to measure retracement of this impulse, I just basically take from high to the low, and then usually the 50 and 618 will be an area to look for entry, right? So in this case here, if I don't use the breakout entry, the other entry that we can use is basically a 618 pullback and then the sell. Okay, now this setup here, the 50, 618 is basically this 50, 618 pullback setup. Okay. So again, same directional bias, multiple ways that you can consider to get involved in it, right? And of course, each setup would have its strength and weaknesses. That's where you need to identify what's the advantage of this setup, what's the disadvantage of this setup. Is this setup suitable for my personal style? Is this setup more aggressive? Is this setup more conservative? You need to make all this decision and see which one aligns with you as an individual. Okay. So of course, pound yen here, right? I personally look at a breakout, okay, but some traders are maybe a little bit more aggressive. They will say, I want to buy when the price comes back here, and then I want to sell when the price comes, instead of a breakout, I want to sell at the top. Perfectly fine, right? I mean, you will get in at a better price, you will make more profit as this drop, but you also run the risk where what if this just keeps going up? Okay, so if I'm a breakout trader, if this just keeps going up, I'm fine. I won't lose the trade because I never get involved in it. But if today you're looking at a pullback trade, a retracement trade, you look to sell here, the market went up and it doesn't reverse, it continue to go up, you would lose a trade, where a breakout trader will not lose a trade. So each entry technique has its own strengths and weaknesses, right? You need to definitely understand that and see which one fits you. Okay. So that's the fits, right? So I use a lot of fits. I think in some of this analysis charts, you can see, right, all the fits levels that we use. We use a lot of fits, but we don't use a lot of different levels, okay? Often we use the 50, 618, and then in terms of extension, we use the 100 and 123, right? These are more of the common fits that I use. Okay. Good. So over here, Aziza also asked how to start counting Elliott Wave and where to start the first count. Okay. My suggestion is always start off with the obvious high and low from the time frame you're looking at. Okay. And don't start with labeling the chart immediately. Always start with looking at impulse correction. Ask yourself, how is price moving? Give you an example. Okay, Aussie yen. Now, this is obviously a significant high, right? And of course, this is a significant low. Okay. Now, if you want to start working from this high and then decipher this move, if you start to just put in 1, 2, 3, 4, 5, it's not going to work. Okay, why? Okay, because this is not an impulsive move. This is a corrective move. You will not label a corrective move 1, 2, 3, 4, 5. Okay. So again, the first step is not to label. The first step is to ask yourself, how is price moving? If it's slow, the immediate thought process you need to have is, okay, if it's coming down slow from Elliott Wave point of view, we have a couple of different patterns, right? Today we share with you one of the most common one, which is just now you mentioned flat. Now, Elliott Wave also have a flat family. Okay, and flat family, the pattern inside can be broken down into a couple of them. Now, you may have studied before, like what we call double tree, triple tree, etc., right? But I just like to simplify things and say price tends to move in tree, right? So from this high, we have 1, 2, 3. Okay, so look at this from the perspective. It's coming down slow. Is moving in sets of 3. It's definitely not a flat. It's probably a flag. If I want to label this, how do I label? A very simple ABC. 3-wave move, okay? Now, I can use ABC, I can use WXY, you can use another 3D alphabets. It really doesn't matter, okay? Because I always share this with traders. The labels you put on the chart is just to communicate the idea. When I have this label here, it's just to communicate what I see, to communicate my analysis with another Elliott Wave trader. Okay, when I'm just doing my personal trade, do I need to label? The answer is no. I probably just use some fibs, right? I can probably just do something like this. Okay, just to show you, right? I can just do this fibs. I can just draw in some channel just to give me some visual cue, and that's it. I don't need to label because I understand this is a correction. I use some fibs to understand where would this correction likely end, and then I can basically just focus on taking trades potentially, right? And that will be the area that I'll be looking for potential buy. Okay, do I need to label? No. Do I need to care about this? Probably not, right? Because I can clearly see this is an impulse. This is a correction. 70% it will go up. That's all I really need on a chart. Okay, so the label looks cool. Okay, the label looks fancy. But to be honest, if you're just doing it for yourself as a trader, you don't really need it. Okay, the label again is just a visual cue. It's just to communicate ideas. Okay, yeah. Good. Okay, so over here I also see a question over here asking, can the impulse pattern ever be wrong? The answer is yes, right? I mean, it's not a foolproof 100% thing. Okay, there's no such thing in the market. There's no such thing in trading. But it just gives you a high probability, right? I just want you to understand. Don't think that, oh, every time you see an impulse and a correction, it's definitely going to go up or down, right? And then you go all in. You don't do that. Okay, it's just telling you the higher probability of the direction is up. Then you focus on buy, right? So understand it's probability, it's not certainty. Yeah. Okay. Chill asks, does the Elliott Wave combination work for intraday chart, like the 1 minute, 5 minute, or 10 minutes? The answer is yes, but you need to really be on the ball. Okay, you really need to be on the ball because things that's happening on the lower scale, like 5 minute, 10 minute, 1 minute, things may not be very clear. Okay. Like for example, okay, if you take a look at what's happening on 5 minute chart on Aussie yen, okay, this entire piece here, to be honest, is not a very clear move. Okay. You can see, right? It's coming up like correctively. We do see some sense of drop, but here a bit of a V, a bit of a chop here, a bit of move. It's not so straightforward. Okay. It's more challenging to do things on the lower time frame as compared to a higher time frame. Okay, so you can see so clear on the 4 hour. not so clear on the 5-minute. Okay. So the suggestion here for you is if you are fairly new to the principle, you want to practice it. Don't practice it on a lower time frame. Practice it on a higher time frame. Once you're comfortable with it, you are very confident in it, you can explore the lower time frame. Okay. So I think Joshua also asked, right? Does higher time frame have better chance? The answer is yes. Okay. Because higher time frames takes time to build up. The patterns are often clearer. The smaller time frames are a little bit more volatile. It's a little bit more choppy. It's not so straightforward. Okay. YC asks, can you show again after the corrections how to determine the move up or down, right? So I'm going to show you this slide, okay, where I kind of summarize it. Let me just draw the annotation in, right? Now when you see this, high chance of up. When you see this, high chance of down. This one here, no trade. Okay. When you see this, high chance of down, and then when you see this, high chance of up, right? So you can take a screenshot, you can take a photo of this. Okay. Cool. Okay. Vicent asks, what is the stop loss and take profit for the setup, right? I think we shared, right? The breakout, I can't show you if you're looking at a breakout to the downside. Basically, you put your entry at the low, you put your stop at the recent corrective high. Okay. Yeah, so invalidation point is basically your stop loss, right? I use the word invalidation because different traders would have slightly different approach to manage their risk, right? Some traders put a hard stop cut loss. There's another technique they can use called hedge, right? You can basically take your opposite direction to enter to kind of like limit your downside and then get your position hedge and then resolve the trade accordingly, right? So you may not cut a trade straight off, but you still need to protect your downside by hedging, right? So we use the word invalidation. The idea is basically, okay, your sell needs to be managed now. Do you want to get out by cutting a loss, or do you want to get involved in a hedge position? That's where we put in the invalidation instead of like just putting a stop loss point. Okay. Yeah, so that's the idea. Okay, yeah. Okay, good question here. I see also from Kenneth. If the price reached the targeted price, let's say 50 and 618, do you buy or sell right away? What confirmation do we need? For me, if I'm using a pullback setup, I just get in. Okay, so basically I use a lot of pending orders, right? Buy limit, sell limit. If it hits the level, I just get involved in it. Now, if you have the time to go down to lower time frame to look for confirmation, it will help to increase the probability. Okay, but then again, you need to always balance, right? Do you have the time to do it? If you do it, sometimes you may miss out on trades. You know, what if the trade hits the level that you're interested to get in, but you're not in front of a computer, you're doing something else? You know, all these are all factors that you need to make decision on. Okay, so for me, I keep it simple. When I use a setup on 50 and 618 retracement, it hits it, I get involved in it. I have an invalidation, and then that's about it. Okay. YC asks, does it help using RSI to confirm possible reversal? The answer is yes. Okay. Now, today we didn't really talk about any indicator, but whenever we talk about this crawl pattern, I do use an RSI indicator to look for divergence. Okay, but I can tell you, it's most of the time you don't really need it. The reason is because when you can identify a crawl, 90% you would see a divergence. Okay, what I mean over here, very straightforward. Even without putting in the indicator, right? Let me go over to pound yen. Okay, without putting in the indicator, okay, I can tell you that this has a very, very high chance you will get an RSI divergence anyway, right? So let me just show you. Okay, that's what RSI divergence is. Okay, most crawl will have an RSI divergence. Okay, case in point, right? Look at this crawl, huge one over there. Gold, okay, as we're speaking, this low and this low, divergence. Okay, so for me, it's just more of a kind of like confirmation. Okay, because I know like 90% of the time it will have it, so I just pull it up, confirm, okay, it's there. That's about it. Okay, so the pattern itself already give you that probability. Okay, the RSI divergence is just an additional layer of confirmation. That's about it. Okay, yeah. Would MACD help? The answer is yes, but MACD and RSI is generally almost the same thing, right? They are more or less categorized as oscillator. My suggestion is choose one, work on it, okay? You don't need the MACD and RSI. You choose either a MACD or the RSI, okay? Another question here, wondering if horizontal resistance and support lines play any role in Elliott Wave combination. Answer is yes, okay? Again, you may want to combine some principles with Elliott Wave as well. Okay, case in point. Okay, look at this example, right? While I don't draw in support and resistance on my chart, okay, but look at this example where if this comes down here, we're interested to buy. Okay, look left. Where are we? Okay, we're basically back at some key support, or I would say resistance turn support area, right? Right. I mean, look at this area here, right? So it does kind of have some confluencing effect. Okay. If you take a look at this one here, why are we taking profits or targets there if you're looking at sell? Because this again is a key level, right? You can talk about it as a support, right? Euro pound, okay. This area here, why are we looking at sell? Simple 1, 2, 3 is a flag, it's a correction. We have the fibs. And then you take a look at the left hand side. Okay, again, it may not be like perfect, but there is some alignment and confluence. It's just that I don't draw it on my chart. Okay. Again, I like to keep things simple. I don't want to overcomplicate when I'm doing my analysis, right? So that's the reason why I don't put in, but the principle of support and resistance kind of complement quite well. Okay, good. Okay, so I hope that helps, right? I hope today's session and sharing over here also give you an idea and insights into Elliott Wave, right? And of course, if you're fairly new to this, my recommendation is really take it, go and practice. You will definitely see how it can help you in your own trading. Right. So with that, I'm gonna pass the time back to Anna to maybe do a closing of the session over here.